Hello, my beautiful friend. Well, it's actually exciting to have you back at this channel. Thank you very much for tuning in, and this is a continuation of our unit 3. So, without any waste of time, kindly read the disclaimer here and let's proceed. In this unit, which is unit 3, part B, we will be discussing types of gaps found in the market. These gaps that we will discuss here are not the only kind of gaps found in the market, but these are the most common gaps that we have seen and studied over the previous years, as we were experiencing with the market. Now, number one, we have what we call a fair value gap. It's also referred to as FVG. Number 2 is volume imbalance, VI. Number 3 is just gap, which means standard gap. And then number 4 is acceleration gap, AG. Let us see exactly what is it that we are talking about. So here we have types, different types of gaps in the market. And in this case, we have what we call a bullish FVG. Okay, so I will explain to you these types of gaps, but our main focus is gonna be on the fair value gap, the FVG. So these others, I will just touch them a little bit, but our main focus will be on the fair value gap. And as you can see, guys, I used this illustration here, with candlesticks, and I hope it's gonna become easier for you to spot them out. Like I said, in this unit, I will not be showing you any practicals on the market. If you would like to learn more, please dive and contact us, join our mentorship program, and grow with us more and more. But this information that I've provided for you already is good enough for you to become the kind of a trader you want to become. But that trader relies only on you from now on to develop that trader. Remember what I said. It's all about the person behind the charts. Okay, so we have here what we call a bullish fair value gap. And how do we spot out a fair value gap? A fair value gap is formed in between candles. Okay, so here we have the first candle, the second candle, and the third candle, and they were both showing bullish momentum rising to the upside. Now, I want you to look at this. The middle candle, the middle candle, there's a zone that I've marked passing through the middle candle. Here on the first candle has a wick, and this wick comes somewhere in the body of the second candle, and then the second candle closes, and the third candle has a wick that comes somewhere in the middle of the previous candle, which was the second candle, as a fair value gap is formed by these 3 candles. So this candle here that is in the middle, this wick, the last wick of this candle, and this wick here, they do not overlap. So if you can check between this wick here, there's a space, there's a space. There's a space here, guys. So that space is a fair value gap, which means that there was a fair agreement between the bulls and the bears, that whatever that happened. Remember, I may not fully be able to explain the deepest technicals on these things, but I'm just gonna be trying to help you be able to identify this thing on the market, because after all, we want to learn to identify what will help us make money, right? Sure. So as I said, these wicks, they do not overlap, and that forms a fair value gap. You'll understand it more. Like I said, we are going to be focusing more on it later. So in this case, we have a bearish fair value gap. The bearish candle that was dropping from a low here, a wick, and then the second candle was in the middle. It has 2 wicks as well, but the third candle's wick did not go above and overlapped the first candle's wick. So this gap that is in between here, okay, let's say we had removed this middle candle. What do you think was going to happen? There was going to be a gap in between here, right? Yes, but now we have this middle candle. Consider that gap still being there. That is a fair value gap. Okay, so in the volume imbalance, here at this point, we have a bullish volume imbalance, and we see that this closing of this candle does not overlap the closing of the second candle, but the wicks of these two candles, they overlap. That is a volume imbalance. Okay, I will not go deep into details explaining how it forms. Just know it. Just know how to spot it out. Identify it on the market. Okay, and then this here is a bearish scenario. Okay, so in this case of just the standard gap, you realize that both the bodies and the wicks are not overlapping, and there's an actual gap in between the wicks of these two candles. Okay, so it's more like there was a little bit of a jump to the upside. All right, so that is just the standard gap. Okay, here is a standard gap, it was bearish. Okay, so here we have what we call an acceleration gap. You can see that although there's this a little jump, this big jump there, it's not like this one. This one, at least it was not as major or big as this other one, you know. So this acceleration gap shows that suppose the market closed here and then jumped, just open a candle somewhere above there, while you and I know that the candles should be, you know, opening, you know, the previous close price action will most likely be the most recent candle's opening price. Okay, so in this case, an acceleration gap, the market just jumped and opened far away from the previous closing candle. Okay, and then that gap signals an imbalance as well, but it pushes the market a little bit to the upside. Okay, it's an acceleration gap, so it accelerated the market a little bit to the upside. And here's what I want you to know about gaps. Gaps in the market are referred to as windows, and we know, you and I, before we leave the house going to visit, you know, our loved ones in different areas, or maybe going to work, going to the shops, we prefer to leave we prefer to close the windows before we could leave, because we don't know what kind of storm will come. So whenever you see a gap in the market, you can always anticipate, you know, don't be too hopeful. I mean, people are not the same. There are people that can leave one state to the other without even remembering to close their windows. So those are some abnormal cases, but under normal cases, windows are closed, so gaps somehow will be closed. So in other words, if this case here, the market went down, as it goes up, it may come to this point and close this window. Okay, in this case, the market may drop and come close this window. Normally the close starts by going to 50%, and maybe there could be a full close, or even if it comes to 50%, they still consider that as a close. Okay, yes, because the market would have now tried to balance, you know, between the bulls and the bears, you know. So yeah, like I said, I'm not gonna be wasting any time trying to explain these other ones that are not our main focus. Our main focus at this point is the fair value gap. So as I have explained, guys, the fair value gap, you can see that these 2 weeks here, they do not overlap. There's a gap, there's a space in between. So if there's no overlap, that is a verified fair value gap. In this case, it was bullish. Okay, but in this case here, you can see that this week was a bit longer, and this one also was longer. So if you were to draw a horizontal line from the end of this week here going to the right hand side, this candle's week was going to break that horizontal line. So that is what we call an overlap, and in this case, there was no fair value gap. Okay, so how do we utilize a fair value gap in the market? Here's what happens. You'll find that when the market comes back to this fair value gap, it will do what? It will most likely close it. Why? Because, like I said, normally we prefer to close the windows. Okay, so it may just come and retest somewhere at the beginning of the gap. That is also considered to be a close, but normally it will come back at least 50%. Okay, sorry. So if you want to capitalize from fair value gaps, you can identify them, and then as soon as the market comes to this zone, in this case it was gonna be more like a demand zone which was created by a fair value gap, right? This is our point of interest. And then as the market comes here, you go into smaller time frames and start looking for anything that can give you a bullish confluence, a bullish confirmation, right? And then you can buy, and then you put your stop loss below that gap, below that gap, and then you put your target according to whatever strategy that you will be using. In this case, you can target the most recent high. Okay, so that is how we spot out a fair value gap, guys. So this one was a bullish fair value gap, which means buy side imbalance, sell side blah blah blah, as you can see it. Okay, so that's it, guys, with a fair value gap. And sometimes as you have learned about order blocks, sometimes you'll find that somewhere here as the market dropped, maybe it had left an order block somewhere here. So don't be surprised if the market mitigates this fair value gap. It breaks this fair value gap. It means that the market will be going to where there are other blocks, pending orders of other institutional traders, and then they are gonna be going there to activate those orders and then go back up. But do not worry and thread, because they have mitigated the fair value gap. Okay, so a fair value gap can sometimes be mitigated, meaning you can try to buy on the fair value gap and then they can hit your stop loss. Like I said, sometimes these things, they fail. You just need to identify them as you practice and learn which ones work best for you, under which zones, under which time frame, under which kind of trend, under which pattern. You just need to learn how to identify the ones that are more reliable for you. So let us look at a bearish fair value gap. Okay, a fair value gap is a sell side imbalance. Okay, yeah, so in this case we can see that this first candle created a low, and then the second candle dropped, the third candle created a high, and in between the first candle's low and the third candle's high, there was no overlap. In other words, there was a gap. So we call this a correct fair value gap. Okay, but look at this. The first candle's low dropped, and then the second candle came, and then the third candle's high overlapped, went into the price territory of the first candle's low. So there was an overlap there. That means there was no fair value gap. Okay, so it means that there was I don't know, maybe a balancing between the bears and the as the market created an imbalance, it went down, then it means that the bulls found a way to balance that. So there's no fair value gap there. How do we utilize it? We can look for sell entries on a bearish fair value gap. But remember, you don't just sell. You always wait for confirmations. Okay? Yes. Then you can find that confirmation. As soon as you find your confirmation, you take a trade, put the stop loss above the fair value gap, and then put your target profit at maybe the lowest low, or on maybe an FTR somewhere there. When it comes to the previous chart, I mean the previous market condition, like in this case the market was rising. So if maybe there was a fair value gap somewhere that was left, and maybe on the downside that was left, or maybe there was an FTR that was left, or a certain order block, you can use those as your targets. Okay, let's proceed. Now, a fair value gap invasion is exactly what I spoke about when I said sometimes the fair value gap can be mitigated. The fair value gap zone can be broken. What normally happens after they break that zone is that they may come back to test it from the opposite direction. So in this case we had a bullish in this case we had a bearish fair value gap, and then as the market went down, you know, it formed the fair value gap here. As you can see, the candles wicks, they were not overlapping, so there was a fair value gap. We marked it out. We wanted to sell on it, but then there was no confluence or confirmation, you know, and then the market broke, went to the upside. When it comes back to this zone from the upside, remember, as it breaks this zone, which was the supply zone, it now acts as a demand zone. Okay, so that is why I say this type of invasion is bullish. Okay, so we would look for our buy entries now instead of sell entries, and then you use whatever strategy that you want to use. Maybe on a smaller time frame, you'd find a double top, double bottom, a falling a falling wedge. You know, you'd find something that can give you a confluence. Then you use that to buy, and then you can target the previous order blocks, you know, as your target. Put your stop loss below the lowest point. In this case, put your stop loss below this fair value gap, or maybe if you want to be a little bit aggressive, you can put your stop loss below this low here, you know. Yeah, so we explained that same thing here, but in a flip side kind of mode. So here there's a fair value gap which was bullish, but then it gets mitigated by this big candle, and then it invades it, you know. It's like there was a territory here, and then that wall got mitigated. There was an invasion. So this big candle invaded this fair value gap, and then we are no longer looking to buy because now we are on the lower side of the fair value gap. Now this, which was considered to be a demand zone, the bullish fair value gap, now acts as a resistant zone. We start looking for sells there as the market goes back to retest, and then we sell as soon as we find any. If we don't find any confirmation, you leave it. You know, the market will always present you with so many opportunities that you cannot finish them. The market has been there before you were born. The market, okay, let me not say this, okay? The market is here, so trade it. Yeah. Well, guys, this is the end of part B in unit 3. Don't forget to like, subscribe, and share this video if you haven't subscribed yet, and look for us in various platforms, you know, social platforms, and you might find that we are there as well, and maybe that is your most preferred platform. Contact us for more information, but there will be unit 3 part C, and that will be the end of this course. And for more videos, you can join our mentorship program. Like I said, thank you very much, guys. God bless you all.